All right, team. I believe we are live. Confirmed. Okay. So, man, is there a lot to discuss today? Where do I begin? Listen, I try to just shoot you straight on this channel. That's really what it's all about. I shoot you straight. I've seen this stuff happen before. Been through market corrections. Been through market cycles. Have seen what happens in different industries when different things take place. Sorry, I'm just sharing this real quick. And I can tell you that what we're seeing right now is a familiar sight. And I'm just going to show you a few things today. I'm going to show you a few things. You take away from it what you want. I'll tell you where I stand. I would prefer you come to your own conclusion than to just trust me. I'm going to bring information to you. Let's see what it says. Derrick Evans here, home loan specialist, NMLS 155010. Call me if you want to buy or refi. All right, so let's go in here. We'll get rid of this, and let's take a look at what's going on. So first and foremost, Fed stuff today. We're going to talk a lot about this. Fed holds rates, no change, no change in expectation there. Nothing really. It's kind of a nothing burger. I'll show you what you need to see from it, but it kind of is what it is. They said the economy's gotten better with the pandemic concerns, and that's been true. We haven't been reopened for very long. And that all could change here very soon. So let's dive into a couple things. First of all, oil still at $72, holding in strong there. Gold did jump above 1,800. So right, of course, I make fun of it the next day it pops. Crypto back up to around 40,000 for Bitcoin, and a lot of people saw that pop. They're from 30 to 40,000, really into it. Listen, I'm dollar cost averaging, so it really, it doesn't hurt as much when it goes down, and doesn't feel as good when it goes up because you're buying more. So that's my suggestion with that for sure. Today, markets are relatively flat. The Dow was down 130 points, but it's only 0.3% now. That's the thing. You see down 130 off of a 35,000 basis. It's just not that much. S&P basically flat. NASDAQ up 100 points. Russell up 33. I do feel like a bet on the VIX right now makes sense. I'm about to show you why. Now, we're going to look at something here. Oh, I saved this for, let's move this guy over here. We're going to talk about that in just a second. So there's one article I want you to read, and I'm going to post this. I'm not going to talk too much about it, but CNN Business, listen, all of these major media sites, as I've told you, are paid-for sites. Most of the content is garbage. It's propaganda. This is actual journalism, and this was just a couple days ago, or yesterday, actually, this was written, or was updated, I should say, by Matt Egan, and it's genuine journalism. Home prices can't go straight up forever. Fact. But this probably isn't a bubble. Fact. Okay? And he goes in to break that down, giving all kinds of numbers, all kinds of data, very in-tune analysis, using also analysis that's been done by other major banks and people who follow real estate. Very, very, very good article. Okay, so I'm sharing this. So when I tell you, I'm just following the truth. I don't care if it's CNN. I don't care if it's CNBC. I'll tell you when something's true. All right? Now, here's another thing that's true. And this is where today gets interesting. CDC reverses their indoor mask policy, saying now that fully vaccinated people and kids should wear them indoors. Now, if you will recall, and I don't do this very often, my video from July 8th, okay, so what is that, 20 days ago, almost 3 weeks ago? Everyone should expect masks to be back by fall. It didn't even take them that long, did it? Why was I saying that 3 weeks ago? Well, look what I wrote. The propaganda on my favorite propaganda site, CNBC Today, is telling us a story. The powers that be are going to be sending us down the same path again with pandemic and the shots. What does this mean for real estate interest rates? Okay, you can see it's clear as day. As long as you know what the agenda is, then you can see it coming. If you know what a given outlet's agenda is, you can see where they're coming from. And so when you see a certain message, you can know whether that's part of the propaganda or not. And in this particular case, the CDC is now saying that even if you're fully vaccinated, you need to wear a mask indoors. Two problems with this. Number one, people are going to be pissed. Number two, it disincentivizes people to get vaccinated. If you believe that people should be vaccinated, I'm not vaccinated. I won't. I'm not a needle guy. I won't take shots unless I absolutely have to. Just don't want to. I had COVID and it sucked, but I still won't take a shot. So, this is going to just less incentive for people to get vaccinated. I mean, I kind of thought the whole idea of, hey, you don't need to wear your mask if you're vaccinated was a good idea, for honest people anyway, to try to get them to not wear their masks and to get vaccinated. So I told you 3 weeks ago this was going to happen. Lockdown's coming. We're headed down that path. I promise you this is where we're headed. And I wish I was wrong. I hope I'm wrong about this. But if I could bet a lot of money, I would bet that we are headed back to the same path. The Delta variant, all this stuff, there's going to be more stuff coming from the federal level. There's a lot of governors that are behind this, and they're going to push some pretty hard stuff. Now, I don't know if it's just going to start with mask and stay with mask, or if it's going to go to full lockdown or not, but be prepared for it to be us to be back in full lockdown mode by the end of the year, okay? Particularly the holiday season. And I think that they're going to justify that with, a lot of things that will make it seem like it makes sense to some people who are scared. And so, there may not be a ton of pushback on this, but what we have to look at is, what happened the last time we went down this road? And we don't know for sure if the market is going to act the same way. So we have to remind ourselves of that. The market won't necessarily act the same way. But the last time when we entered a lockdown state, and that we knew that was going to cause problems for businesses are going to shut down. This time it may be a little bit different because businesses have kind of figured out how to operate. They've got, restaurants have things in place. They've built hardware into their businesses so they can try to accommodate. So it shouldn't be as bad this time. But you remember we had a really steep drop off in stocks. We had kind of a frozen 2 weeks in real estate, and then everything took off like crazy. I don't know if we're going to see the same takeoff this time or not, but I do believe that we're going to see trouble with stocks. Why? Remember this one? I want to make sure you note here, this one is from May 6th. Again, this is the video I did back on May 6th saying, if I could move my own thing out of the way, did the Fed just warn us a stock market crash was on the way? Fed warns about potential for significant declines in asset prices as valuations climb. And they specifically said in this article, they mentioned stocks. Let's see if I can find the exact quote here. I just remember them saying specifically treasury yields. Okay. Anyway, sorry, I should have found that before we went, but they specifically said stocks and other assets. And so we were kind of thinking like, okay, what does that mean? Stocks and crypto? Does that mean stocks and everything? What does that mean? But they mentioned equities for sure. This is on May 6th. So now we're talking 2.5 months ago. 2.5 months ago, the Fed, as far as I know, as far as I've seen, I've been tracking the financial markets for the last 20 years. I've never seen the Fed issue a warning about significant declines in asset prices. Never. So here's the path we're heading down. We're heading down the path of more restrictions, more COVID issues, masks, possibly lockdowns. We have the Federal Reserve who warned us just a couple months ago, hey, be prepared. We have the Dow Jones, by the way, and I pulled this up because I wanted you to see this. So that was on May 6th. Look at this. May 6th was right here. That was at 34,500, let's call it. That day and the preceding day went higher before it went lower, right? So the sellers got out of the way. They let the market go up on that news. And the reason why I want you to pay close attention to this is because Jerome Powell said this. The Federal Reserve issued this statement. Whether Jerome Powell said it or not, the Federal Reserve issued the statement. They constantly try to tell you that the market is moving because of what the Fed said, right? They're constantly trying to tell us that, oh, well, the Fed did this, the Fed did that, so the market's down today or the market's up today. But when the Fed came out and said that significant declines in asset prices were on the way, the market didn't move at all. So I'm not conspiring here. I'm not telling you there's a conspiracy. I'm telling you what's going on. There are people who manipulate the market and then they tell you the reason, or they give you the headline that associates with the reason so that you'll believe it. And right here we have proof that the Fed and Jerome Powell have absolutely no power on their own. They told us significant asset declines were coming and the market went up 2 days in a row before it came down. So there is no power in what they're saying. It's the people who are manipulating the market. They decide where it goes. I think this is swept under the rug for a lot of people. I don't think most people know that the Federal Reserve said this. I think if we did man on the street right now and I went and interviewed 100 people over here in Poway and said, hey, what do you think about what the Fed said about significant declines in asset prices? I think 100 out of 100 people would be like, I have no idea the Fed said that. So I'm glad you're watching this because you know that they did 2.5 months ago. And now as we're heading down the same path, okay, this one, Fed warrant, yes. Nope, don't need that one. Here's what changed in their statement. And I'm putting these links in the YouTube. By the way, I put all the links in the YouTube. Follow YouTube if you're watching on Facebook. Or subscribe, I should say. And they didn't change much. I mean, look at the statement. They literally say the exact same thing, and they change just a few words. I mean, it's so plastic. There's just no genuineness to this at all. Talk about a contrived statement. But anyway, with progress on vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen. Okay, they feel good about things. The sectors most adversely affected by the pandemic have shown improvement, but have not fully recovered. Inflation has risen. Thank you for the confirmation, largely reflecting transitory factors. We were not going to mention any of those transitory factors, but we're telling you, and you should believe us, it's just transitory factors. Overall financial conditions remain accommodative, in part reflecting policy measures to support the economy and flow of credit to U.S. households and businesses. We're going to look at mortgage bonds here today because on a Fed release day like this, that's where you can really kind of tell what's going on. I did want to show you this one. Remember Blackrock? We've been talking about Blackrock a lot because they've been buying a ton of real estate throughout the country, including here in San Diego. And this guy who represents them is, this was today, by the way, and this is, if you're a subscriber to the Pro, I am not. It's probably worth checking it out. But he's basically saying that, hey, the Fed could begin tapering bond purchases in November. Now, why would he say that? I think it's mostly wishful thinking because I think they want interest rates to be higher. And I think that they want to buy more real estate and they know higher interest rates will give them cheaper prices for that. But you're still going to get the same rent. And I think that's what they're thinking there. So that's my opinion. Now, this is a Pro article. It's a Blackrock guy who's being interviewed. So you tell me, you think that this is an editorial interview or an advertorial interview? You tell me. Okay. So we're going to leave that for a second. We're going to head over here to mortgage bonds. Now, people have been asking me to explain how the bond market works. And that's a very long and boring explanation, unfortunately, for most people. But there are some people who have asked for it. So I'm going to make a video soon where we'll go into more detail about how the bond market works. But essentially, you're buying paper, which is debt. Okay, so when you buy a bond, when you buy an Apple bond, okay, or when Apple wants to raise money, which there's no reason for them to have bonds, but they have them and they have all this cash. It makes no sense. But you can buy Apple bonds. And so they raise money, they say, hey, we're going to issue $10 billion worth of bonds. And you go in and you buy the bonds and they give you a certain percentage rate. Let's say they pay you 3% over 30 years or whatever. And it's 3% annually over 30 years. Probably none that are that high right now, but if just as an example. So 3% over 30 years, so you get your 3% for holding it. Now there's a price for that bond, which is par at 100. If there's a demand for those bonds, they'll trade up above that. Like right now, we're looking at these Fannie Mae bonds. See how they're trading right now at 101.87. So that means that the yield on that is actually less than the coupon rate. The coupon rate is 2% for this one. See here, 2%. So if it trades above 100, then the interest rate goes down. If it trades below 100, then the interest rate goes up. This is the reason why we want to see bonds moving higher. Okay. But you can, when you buy a bond, let's say you buy it for 100 and then it goes up to 101 or 102, you can sell it and make a 2% gain just in principle. Okay. Just appreciation. So that you do have the possibility for that with a bond. But it's also possible that it could go down. Now, if it goes down, you're still going to make what you were promised at the end, because at the end of the term, you get your original investment back. In the meantime, they're just paying you the yield. And that's kind of how it works. So I could give a more detailed explanation, but like I said, it gets pretty boring pretty quickly. So the bottom line here is we want bond prices to go higher. And guess what? They have been. This is the trajectory that we're on, and it looks really good. Aside from those 2 days right there, where we kind of snuck underneath this trend line, but we had to come down to support. I mean, look at all the support that was down here. It was just natural. It's like a gravitational beam, just, when there's that much support, from the moving averages, it just sort of attracts the price. A lot of buy orders get put in down there, and so the market just gets there. But if you look at this trend line, it's really, really good. And today what was interesting, at one point we were down 24 basis points today. Right now we're up 8 and the market's closed. So, that was bad. So we were down 24 basis points. We ended up 8. That's a 32 basis point swing in a day. And we did come up and we touched again the 200-day moving average right here. We touched it again. Here it is. We've touched it twice before. So we're knocking on the door. I got to tell you, team, it just looks like bonds want to go higher. When you look at the chart like this, it just looks like it wants to go higher. And what the Fed said today was basically nothing, a nothing burger. And, bonds reacted well. They reacted well and went higher. Even though we had kind of a tumultuous day, they held the trend line. And so there's a little fork in the road here. So now we've got this 200-day right here, and we've got this trend line here. And you can kind of see okay, we're going to need a breakout one way or the other. But the safe bet is that bonds are going to head lower, because the 200-day is a very, very strong moving average. It's going to be difficult to break through. But we've knocked on the door 3 times right now. So if we can get up here, we're going to see all-time mortgage rate lows again. If we head back down this way, we still have great mortgage rates. But here's the thing, the taper that he's talking about. So this guy, again, we're going to go back to him, Blackrock guy, reader. He says the Fed could begin tapering bond purchases in November. Now, why would he say that? How do you know? We just had a statement from the Fed. They said that a lot of things have to change before they're going to do anything. So how would you know? Again, is it advertorial or editorial? You tell me. So how would you know what the Fed's going to do? They've said they don't want to make any changes for the time being. If they do taper, what's going to happen is they'll stop buying bonds and at the rate that they are. So they'll go from buying, let's say, $6 billion a day in 1 month to $5.8 billion the next month, and then $5.6 billion the next month, and then $5.4 billion. That's the taper. So they're just going to slow. They're still going to be a big buyer for a long time, but they're going to slow down the amount of purchases that they're going to make so that they can hopefully exit out and let the free market reign. Because right now, the free market would not be paying 102 for these bonds. I promise you that. And I think ultimately, and the bond market, by the way, is the biggest of all of the financial markets as far as investing is concerned. Way, way, way bigger than the stock market. I mean, like 1,000 times bigger, and bigger than anything else. Way bigger than the real estate market. I believe the bond market is like 100 trillion or 120 trillion. Some insane number. We can Google that. We'll figure it out. But I mean, it's just humongous. So if the bond market is that big, and I think it's under attack. I think it's under attack for several reasons. I think that the government and the Federal Reserve both want interest rates to be as low as possible because the government is creating debt at a record pace. And in order to service that debt, make the payments, you need rates to be low. If rates go up, that causes big problems on the budget, which there already are huge problems on the budget. And can you just keep, printing money forever? You really can't. You really can't. And we're starting to see the effects of potential hyperinflation, which could be right around the corner. Now, if I'm right about what's going on with this, we're headed for a lockdown again. We're headed down the same path we were before. Everyone's been through it this time. Everyone kind of knows what to expect. They're going to tell us the same shit. Oh, yeah, for 1 month. We just need it for 1 month. Everyone to just lock down for 1 month. 9 months later, we could be headed for one of those kind of situations. If I'm right about that, I do think stocks get hurt a lot because I do believe that a full recovery is priced into the stock market. I also have been seeing, if you just look at this simple chart right here, and we were looking at the 3 month, where we were looking at, when Jay Powell warned that, assets were going to get smashed and then the market went up. He has no power. It's not him. It's not what he says. It's not what the Fed says. It's the powers that be who are moving the markets. But notice there was a sell-off, and then they kind of got out of the way and let it climb back up to the exact same spot, and then another sell-off. Is this big money exiting? Are those sell-offs big money exiting? And we're seeing those 3 different spikes there to the downside. I don't know. Do not know. But it feels fragile. But every time we have a big down day in stocks, the recovery is almost immediate. And that is super bizarre to me, but it is what it is. This is what we've been seeing. So I do want you to read this article. If you're interested in real estate, read this article. Be smarter. Okay, this article will make you smarter. There's good journalism in here. There's good research in here. There's good data in here. There's tons of third-party information. This person did not come with an opinion and slam it down our throats. He said, here's what's going on. This could happen. This could happen. Here's what people are saying. Here's what the data is saying. It's perfect. Perfect journalistic tone by Matt Egan on this one. So I really highly recommend that you read this and revisit this link too. Revisit this one about what the Fed has said regarding the significant declines in asset prices that they expect. Okay, they're warning the public about. Almost no one knows about it. Expect rates to continue to stay strong, at least for a little while. It's possible that we could bounce hard in a bad way off of this 200-day moving average, but I don't feel that. My gut tells me that we're actually going to climb higher and potentially revisit some of the old lows, all-time lows in interest rates, all-time highs for mortgage bonds. So I hope I'm right about that, but I could be wrong. So lock carefully out there. If you like it, lock it. If you're in purchase contract, lock your rate today. If you are, refinancing, decide if you want to take the gamble or not. But either way, you can always feel free to give me a shout out. Here's one thing I do want to make sure everybody knows. If someone's made an offer to you or whatever for a refinance or something, just give me a shout and let me look at it for you. Let me just make sure you're not getting screwed. Too many times we see that happening, and it's just really a shame and totally unnecessary. So give me a call, text, shoot me an email. Happy to help. Everybody had a great day, and I hope it helps. Talk to you soon.